Hey everyone, so I appreciate you joining me here. I know I'm off to a little bit of a late start, so I appreciate the patience as well. If you don't know me, I'm Patrick Camuso. I'm the founder of Camuso CPA. Through my firm, I've been working with crypto investors, founders, miners, Web3 startups since 2016. So, I've seen all sorts of transactions and tax scenarios through all types of markets. And I was recently recognized as Forbes Best in State CPA for having a firm that's known for tackling some of the toughest accounting and tax challenges in the cryptocurrency industry. So today I want to walk through some questions I've compiled from newsletter subscribers, people on LinkedIn and Twitter that have messaged me, even during some client calls that I've recently had. Some of the questions that I'm sort of seeing out in the market that are top of mind for people. I want to take a little bit of time here and try to address some of those for you here live. And also, this is right now across LinkedIn, Twitter, as well as YouTube. And I'm monitoring all those channels here on my phone. So if you do have specific questions now, I will prioritize those. So just sort of comment those in the chat and I'll take a look at those here every now and then. And I'll be sure to respond to any questions as well. The first question that I've been getting a lot is around wallet-based tracking. Most people haven't heard of this yet. But every now and then someone is saying, I've heard something about wallet-based tracking. What is this? And what this is it's related to Revenue Procedure 2024-28. This is basically one of the biggest changes that we've seen in crypto tax and accounting, in the better changing the way that cryptocurrency accounting has to be done for tax purposes. Before 2025, it was done a universal basis, meaning you would just apply an accounting method on an asset by asset basis. Starting in 2025, the requirement is to not only apply that accounting method on an asset by asset basis, but also on a wallet by wallet basis. So, there's going to be more complexity and more stringent requirements to the accounting going forward. Now, for people that held assets before 2025, you should have already completed steps in terms of documentation and an allocation procedure in order to comply with this. And if you haven't done this, you are behind on this. And that's what I'm seeing. Most people are still coming to my firm at Camuso CPA, and they need to clean up years of accounting. Sometimes 5 to 10 years of accounting. Really, in most cases, 5 to 10 years of accounting. So you have to do that before you can even get an accurate basis calculation. And then from there, you need to do allocations to take your universal basis and allocate it to where you're actually holding assets in your account. So not only does this require your accounting to be up to date, it also requires it to be accurate. I can't tell you how many people I also see come with inaccurate accounting to my firm, whether they self-manage it on a software or many times even if they worked with other firms. There's just not the proper due diligence specifically around the calculated ending cost basis matching the actual cost basis across accounts, across exchanges and wallets. So you need to have that accurate so you can do an accurate allocation. So that's really the first step. Most people are behind on this, and the revenue procedure did change this accounting requirement. And it's also now officially defaulting everyone to FIFO if you haven't elected specific identification. And it's given much more clarification on what's required for specific identification. And, most people can barely meet the bare minimum compliance requirements when it comes to crypto accounting now. So if you're out there thinking you're going to be able to comply with Spec ID, I don't give you a high probability of being able to do it unless you're very much on top of your accounting. Now it requires documentation um, at the wallet and exchange level. And it requires pre-flagging of tax lots that you're selling before the transactions take place. So you're going to have a very robust accounting system to manage something like that. And you're also going to have to do a lot of planning in advance of every single specific transaction that you do. So, that's what this revenue procedure did. It introduced the wallet level tracking, and it introduced more clarification around what the requirements are for Spec ID. And the goal of this was twofold. It is to align taxpayer records with the 1099 DAs that are coming out, which is going to, create compliance issues for a lot of investors and businesses starting in, this upcoming tax filing season. And it was also designed to stop the way when people were on universal accounting, they were applying HIFO, claiming it under Spec ID, and then creating audit trails under a universal basis, often that didn't match their actual flow of funds on chain. So with the standing orders and with this account-based tracking, it basically clarifies that that's not permitted. At my firm, I always viewed that as an issue, and we never advised clients to do that, and we never permitted that to be filed like that. But that was a very common practice. Everyone would basically go into these softwares, dump their wallets and exchanges in, and just select HIFO and get the best accounting methodology, even if those assets weren't really moved between wallets and accounts the way it was reflected in ultimately in the audit trail. So that's what this revenue procedure does. So, if you're out there listening to this, what do you need to do? Number one, your accounting needs to be up to date. It needs to be accurate, and then it's going to need to be allocated from universal to account based, following, a methodology that is set forth within the revenue procedures. And there's ways where you can strategize around that. And then you're going to need to start to maintain that wallet-based tracking going forward. Now, once you go through these steps to get into compliance, there's going to create a risk for taxpayers who are not into compliance, and this is going to ensnare a lot of taxpayers. But for taxpayers that are able to get into compliance, at Camuso CPA, we've gotten many investors into compliance. I don't know the exact number right now, but definitely over 100 investors into full compliance with the revenue procedure, but also taking an additional step of planning in advance for how they structure their wallets and their flow of funds moving forward. Because if you're proactive, even under FIFO, there is an opportunity for tax planning and to gain control over the timing of your tax events. If you have assets that have different tax lots that have a large degree of variability, like maybe you were accumulating Bitcoin or Ethereum over a long period of time, there's many different tax lots. I developed a strategy called Seg FIFO, where you can take the different assets once you're under the account-based regime and strategically segregate them into different wallets. And then, based on your overall tax fact pattern, whether you want to defer gains or accelerate them if you are sitting on losses, you can gain that level of control over deciding, do you want to dispose of tax lots from a wallet where assets are sitting at a high cost basis, or vice versa, where assets are sitting at a low basis if maybe you are sitting on losses. So that's kind of the long and short of the revenue procedure. But I think it's one of the biggest risks and opportunities right now for investors and for businesses. And unfortunately, I'm seeing a fairly low level of compliance overall. But once you get into compliance, there's a big opportunity there. Let's see here. So someone is saying that their software says that everything's complete, but the numbers feel way off, and they're not even sure what's right anymore. and what should they do? So, that is a common issue. None of these crypto accounting softwares are going to be plug and play. You're going to need to do a deep reconciliation and likely do a lot of updates to your transactions to get it accurate. And you're going to have a strong due diligence process in place to ensure accuracy and data completeness across all of your calculations related to income, spending, your gain or loss, and your ending cost basis. A lot of times, even if things do sort of feel accurate for the current year, you may be overlooking things in your ending basis that can hurt you in future tax years if that basis isn't calculated accurately. And now you combine this with the fact that you need to make sure you're in compliance with the revenue procedure going forward. There needs to be a strong level of oversight and review and review not only within the software, but across the block explorers, and making sure that you're not missing any transactions and that the flow of funds is accurate and that the right tax categorization is being applied to it. So, that's what we built at Camuso CPA. We've built cleanup systems that are going to get you accurate accounting that doesn't rely on one software. We're not just plugging this into one of the latest softwares and just giving you a tax report. We'll actually go through this in detail, track and trace your transactions, and fix everything that these softwares missed. So really, there's no perfect solution. You're going to have to go through and do the hard work of the reconciliation process in getting accuracy and data completeness. Okay. So someone's saying, what exactly is SegFIFO? So SegFIFO is a tax strategy that I created when, I was in this process of analyzing revenue procedure 2024-28, bringing clients into compliance with it, and then realizing that there is this opportunity, a tax planning opportunity. And that's basically how I developed SegFIFO. And there's a white paper on it, the full details of it I'm not going to get into on here because it'll just sort of capture like the full time span. I'm going to do a separate video on it. There's a white paper on it on camusocpa.com under our resources section. Ultimately, it's a wallet segregation strategy that is IRS compliant, that allows people to operate under FIFO, but have a high degree of control over the timing of their tax events, similarly to if they were properly implementing spec ID. So, it's not apples to apples. There's differences and there's a lot of nuances, and there needs to be considerations on an asset by asset and definitely a blockchain by blockchain basis. But this is the strategy that we developed at Camuso CPA and that we've been implementing with clients. So someone said, I'm behind a few years on filings and my wallets are a mess. Is it too late to fix this without penalties? It's hard to say. If you're behind on filings and you have gains, likely there's going to be some penalties or interest. But regardless, the best course of action is getting into compliance as soon as possible. People that aren't in compliance with their crypto accounting and their tax filings are facing several risks now, because we are seeing an uptick in tax notices and audits currently, and we can get onto that more later. But also now with this revenue procedure, the longer you're falling behind on this and you're not clear on what your basis actually is and what the actual timing of these tax events are going to be related to your cost basis and your accounting method, it can start creating gains and tax events that maybe you're not even expecting. So, if you're not in compliance and you're just flying blind, there's a large risk from that perspective. Let's see here. So someone said, what is our approach to tax planning for crypto portfolios? It is, it's not just one thing that we're looking at. We're looking at protecting your bottom line and legally minimizing taxes. And there's several different areas that we would look at for this, starting with doing a compliance review, doing the proper due diligence and review on your accounting systems, making sure you're in compliance with things like the revenue procedure, looking at your tax positions related to token classifications, entity structures related to any business operations that you're doing, timing events around any future liquidity events that you're planning, loss harvesting, looking at wallet segmentation under Seg FIFO. These are like some of the preliminary things that we would do in our digital asset blueprint, and then from there, there may be more advanced tax strategies that can fit you or that you also need depending on your portfolio and just your overall fact pattern, where you live, with your businesses, and with your overall long-term estate planning strategy as well. So overall, we're doing a ton of tax planning right now, not just around the revenue procedure, but just around crypto portfolios in general. And I think it's great. I love working proactively with investors and businesses. And, this is what you need to do if you want to really get serious about your portfolio. You need to be planning in advance with an advisor that has a system that's tailored for this, that isn't just focused on tax filings or compliance, or just accounting. All of those are important, but there needs to be a strategy that sits above that you execute on before those stages even come. Someone said, I already have a CPA, but they don't understand crypto. Is that a problem? I would say yes. We're seeing tons of tax notices, and I'm seeing tons of errors and issues in people's filings and their reportings, and still just really haphazard advice a lot of times from firms that maybe aren't doing crypto, and they get a client that has crypto and they just kind of give like shrugged off advice. There's a weird story I have out of a client I was talking to yesterday. I'm probably not going to get into it actually, but there's just sometimes just random advice that's given and a lot of inaccuracies with the accounting, if they're even going to try to dabble in that. So I would say overall, you want to work with a CPA that does have some experience with crypto. Especially if you have a complex portfolio, you need to work with a firm that has a deep level of experience, because it is a full-time job keeping up with crypto. It's not just a niche like you slap on your firm. It is something that you have to live and breathe every single day. So someone saying, I'm a founder, do I need to personally tax plan? And the answer is yes, especially if you're getting equity or restricted tokens. There's a lot of tax planning considerations around that. There may be a lot of cross-border issues and international tax considerations depending on your entity structure. And likely you have a crypto portfolio that you're going to need to bring into compliance too. So, those are some of the things that come up when we're working with founders. And there's a lot of other intricacies that are just going to be fact pattern dependent. So the short answer is yes, you definitely want to be planning in advance. So you definitely should be speaking with me at Camuso CPA or another firm if you do have an advisor, but you want to get planning in advance on that. Someone said, what's happening with IRS tax enforcement? Well, overall, I'm seeing tons of inquiries at my firm every week right now with people that are getting tax notices. And mostly it's the 6174A where they're getting a notice that's saying that there's crypto transactions that may have not been reported on their return, and it's basically telling them to file it. Usually they're right, based on the conversations I'm having with people, and we have to go back and rebuild their crypto accounting, bring them into compliance with the revenue procedure, and, deal with any delinquent tax filings or amendments. So there's a huge uptick in that. Obviously, there's the headline cases of Richard Algren III, which I've covered on my podcast and newsletter. And there's the latest case with the CryptoPunk trader Wilcox, that's pending right now, I believe. That's also been covered on my podcast, The Financial Frontier, my newsletter, The Digital Asset Digest. I also covered that on stage when I spoke at NFT NYC. So Richard Algren III is doing 2 years, I believe. He pled guilty for tax evasion related to Bitcoin. And then Wilcox is facing, I believe, 6 years. Don't quote me exactly because I don't have the info in front of me, but I believe he's facing 6 years for 2 years of inaccurate filings related to CryptoPunk NFT trades. Probably like 80 or 90 each year, I think, somewhere around that. So, I think we're going to continue to see more of these headline cases. We're going to continue to see much more tax notices, and this is going to get further complicated and accelerated by the fact that we're going to have the 1099 DAs that are coming out, which is going to be, more third-party tax reporting that's going out on way more taxpayers. That many of which, because they're not updated on their accounting, because they're not up to date on compliance in general with the revenue procedure, that's going to be a whole nother issue. That's going to further to unfavorable tax scenarios. So overall you want to get into compliance, especially before these 1099 DAs come out. So someone's asking me about NFTs and sales taxes. So yeah, the long and short of that is sales taxes are applicable to digital products and goods. There's several states that have already included NFTs explicitly in that definition, and there's over 30 states that apply sales taxes to digital products and goods, and most likely even the states that haven't explicitly provided guidance yet related to NFTs are still going to, or they're likely to fit in that definition. So I think this is going to become a bigger issue going forward as we start to see more tokenization on chain, more assets come on chain, more commerce, and overall just tokenization of different types of products on chain. So it's something that Web3 companies really need to be aware of. NFT marketplaces need to be aware of. If you're in the real world asset industry and you're creating a marketplace or a startup, this is, has a likelihood that it can impact you one way or another. Obviously, it depends on your specific vertical, but it's something that you want to be planning for. And it's something that at Camuso CPA, we have worked with marketplaces and startups on planning in advance for, and making sure that there aren't any surprises to come with these types of liabilities. So someone is saying, have any of the recent tax law changes helped crypto investors and founders? Yes, they have, and I'm going to have to do a whole separate video on that as well. I would say, I've been working with several miners, and one is bonus depreciation, 100% bonus depreciation. So that one is huge. It allows basically full deductibility if you're buying mining rigs and other equipment. And there's several others for Web3 businesses with the R&D tax credit. So like I said, I'm going to do a whole separate video on that. And I do believe that we may see some more changes related to crypto taxes here in the future as well. So I'm on a lookout for that too. So to everyone that's listening here, I really appreciate it, and I hope I was able to answer all your questions. If there's a question that you do have that you don't want to ask publicly, or that you didn't get a chance to, or maybe I missed it, because I'm across 3 different platforms right now. So feel free to DM me. I'm happy to speak on it further. But if you listen to something that I discussed here today and you do feel like you're behind, or maybe you think something is off, I would tell you to, investigate it further and trust your gut. You want to start playing in advance when it comes to all this. And what I see is that most people are behind, whether it's on their accounting, on their documentation, on their revenue procedure compliance, on their tax planning related to all of these factors, or just future events that are going to be coming up for them as an investor or founder. Um, if anything I discussed specifically, like the accounting cleanups, seg FIFO, NFT sales taxes, portfolio tax planning, planning for you as an investor if you're launching a Web3 startup, if any of these topics are something that's top of mind, feel free to message me about that. Otherwise, I think I'm going to sign off for now and get back to work. But I'm happy to speak with anyone individually. So feel free to reach out to me here on either LinkedIn, Twitter,